Good morning, everybody. It's Mike with Vant Trading with session 4 of 20 of our beginning day traders course. We're going to be talking about trading assets today. We're going to finish up week number 1. And, sorry we had a little bit of a delay yesterday. It's in Key West, Florida, which is where we were basically out of. Got shut down from an internet standpoint. So we're doing this class today, Saturday, and let's get right into it. Let's finish up week number 1. Got a jam-packed class for you, so I think it's going to be good. Again, finishing up with the habit of the week is discipline. Okay, we hammered about this habit every class. And we're going to spend a good time on it now because it is the most important habit to have. Make sure that you are taking discipline serious. Make sure it's a priority. Everyone thinks they can win. Day trading, we talked about it. I mean, I've seen numbers as low as 1% as far as the number of successful day traders. It's just, everybody thinks that they can be a good day trader. Everybody thinks, oh, this is easy until they actually step up to the plate and actually try to day trade. So, discipline, it's the number one habit and trait you must have. If you do not have it, if you don't work on it, it's not going to, you're not going to be successful. And it's really the number one habit to have in life. To be successful with anything, it's a muscle. Discipline is a muscle. It must be worked on every day. Okay. It must be at the top of your focus. Okay. And you need to have it to make sure that you're following your trading plan. So when we're talking about trading, discipline to stay focused, not to make those mental mistakes. And also discipline so that, you're following the trading plan that you put together. It's so important. And that's why, again, repetition is the mother of all skill. Steel forges steel. Okay. It is important, think about all the successful people out there that you may follow, and they all have one common trait. It's discipline. Another thing is, look, you got to have a burning desire, right? If this is not a passion, if you're coming into this to try to day trade and you're doing it to make money, well, then you might as well just stop now because you're wasting your time. Okay, you have to have a burning desire. You got to have a fire in the belly, man. And if you don't have that, if that's not what you have for trading, then, stop right now. If you haven't followed everything and, and you stopped looking, let's say you fast forward through some of these classes. Oh, I already know this stuff. This is not for you. Okay. Because it's the small things that is going to really make you successfling. Look, we talked about it. Okay. You're building your own business. Okay. There's no two ways about it. Building, being a trader professionally where you're looking to pull alpha consistently out of the market, you're able to do that. Okay, I'm telling you right now, I don't care. The market doesn't care what degree you have. It doesn't matter whether, what your pedigree is. Didn't matter how you grew up. None of that matters. Okay, that's the beautiful thing about building a business. Nobody cares if you spend, thousands upon thousands of dollars going to school, but you're building a business and you got to have that one trade discipline, and you got to have the one trade. You got to have that burning desire. I went to an Anthony Robbins leadership course. This was about maybe 15 years now. It was a 10-day course in Hawaii. And he had all the best of the best there at this in Hawaii. And, it was interesting. He had a bunch of leaders come up and speak. And one of the leaders that got up and spoke was the founder of Panda Express, which is, a takeout food service. And the one thing that really impressed me about that speech was he said, look, he did a lot of research before he started his company. And what he found was, of all the successful business owners, they all had one trait, and it was they had a burning desire. They had that fire in the belly. Because look, and it's so true, and it really hit home, because if you're going to trade, this is not easy. It is not easy. And I don't care who you are or what you've heard on the internet. It's not easy, but it's possible. And so it's got to be a passion. You got to have this burning desire in the belly, because when it gets tough, that's what's going to carry you through the tough times. Okay. That's what's going to carry you. So if this is not a passion for you, if you don't have that burning desire, look, you might as well stop now, because it's not going to work, because you're going to have tough times. You're going to lose money. Okay. You're building that business, right? It's the small things. It's the boring stuff where the success lies. Okay. This week and next week, really, as far as the lessons are concerned, is really where the juice is. It's really where the secret to the success is. Okay. And I know a lot of you, statistics say a lot of you are waiting to week 3 and 4 so we can talk about, trading setups and, how do we pick the stocks, the sexy stuff. And if you're one of those people, then you might as well stop now. Okay. I'm just telling you, don't waste your time. It's the boring stuff. It's the small things. Okay. If you don't understand, repetition is the secret to success. It's the mother of all skill. Then, you're missing a key ingredient. Okay. Because when you're building your own business, you don't have a boss. Okay. You don't have a boss. Nobody's going to be standing over your shoulder saying, get the F out of bed. Nobody's going to be standing there saying, follow your trading plan, stupid. Nobody's going to be there holding you accountable. You need to be able to hold yourself accountable. Okay. You got to understand this, because this is so important. Okay. And by the time you get to the market, by the time the market opens, look, that's game time, bro. Okay, that's game time, man. It's just like an elite athlete. You think an NFL player is sitting there thinking about exactly what they're going to do by the time kickoff happens? No, it's all the hours and hours and hours of preparation before the game kicks off is where the success is found. It's the same thing in trading. If you're trying to figure out how many shares and what stocks you're going to be trading the day of the market open, well, then you're doing it wrong. Okay. It's kind of the same thing as being a lawyer, right? By the time a lawyer gets to court, man, that's a show. Okay. They're not asking questions they don't know the answers to, right? They've researched and interviewed, witnesses. By the time they get to the courtroom, by the time the judge strikes the gavel down on the bench, they already know. It's like a show. They already know what questions they're asking. They already know what the answers are going to be. Okay. It's the same thing in trading, the same exact thing. So, you should have to do a little mental checkup here. Okay. For week 1, you should already have a discipline plan put in place. You should already have a daily schedule put in place. You should already have your equipment list figured out, put in place. You're building a business. You should have your office space figured out and mapped out. Okay. So if you haven't done that by now, okay, then you're not looking at the little things, man. You're not looking at the little things that you need to have and that you need to do to be successful. And I don't care what you think about that, because you know what? We have been successful in trading, and that is what you need. If I got to take a hammer and I got to swing it and over your head over and over again, I'm going to do that, because I know how hard trading is, and I know it's the key to being successful. So, make sure that you have these plans in place. And, one of the biggest traits that I've seen in my years, as far as one of the biggest negative traits you can own, is ego. Okay. Ego takes many forms. Okay. Ego of thinking I know too much. Ego of, oh, that's not important. Ego, I know better. Okay. Having an ego kills more business owners and kills more deals than anything I have seen. So don't have an ego. Okay. Don't have an ego. Make sure you do the little things. Make sure you have this. Now, you should also be well on your way. You got the weekend. You should be well on your way to having the first two parts of your trading plan built. Okay. You should have, those parts, the vision statement. You should have the purpose statement. You should have those parts of the plan already in formation. And again, remember, take the time, sit down, don't be interrupted. Make it a priority. This is important stuff, okay? And if you follow us each and every class, we're giving you the steps, okay? And remember, you're not paying for this. This is well over a $5,000 valued course. You're not paying for it. So a lot of times when somebody gets something for free, they don't value it. So we want to make sure you're valuing what you're getting, because you're not that, it's true. That's why people charge a lot for certain courses and stuff, because really it has that effect of, providing more value in your mind and a lot of people more responsive. So you're not paying for this. So make sure that you take it serious. Okay. The other thing is, we've been having meetings all week. Okay. And I've only seen a couple people show up in any of the meetings. Okay. So again, it's important. And if you want to get a sample example of my daily schedule, okay, because I tried to attach it here, but I couldn't get it formatted correctly so you can truly see it. Just drop an email or drop a line or send us an email at info@vanttrading.com, and I'll send you a copy of that. If you also, we're going to have a course, not a course, but we're going to have a mentorship group on Zoom on Sunday, where we're going to be going through charts. We're going to be going through some more stuff. And if you want me to take a look at your first two parts of your trading plan, or you want to get a sample copy of my trading plan, drop us an email, info@vanttrading.com. Or if you want to drop your email to us, you can do that. And, we'll get you more part of the mentorship group, what we're going forward. And again, I know a lot of people are suspect of this, but there's no cost. We're not charging. There's no secret hidden thing that we're going to ask you for money down the road. We just want to build some successful traders, because I see a lot of bullshit out there. And I also, I want to see if we can find some good traders that can trade our fund. That's what we're looking for. All right, let's get into it. Today, what we're going to talk about, again, building that financial foundation, we're going to talk about trading assets. Okay, trading assets. Let's dive right into it. Okay, there's four primary asset markets. You have commodities, you have bonds, okay, you have stocks, and you have currencies. Okay. Primarily what we're going to focus on is the equity markets. We're going to be focusing on stocks, because 90% of the people, or 90% of the trades we're going to make is in the equity markets, and it is in stocks. Now, we are going to talk options today, okay, which is part of the equity markets. I consider it part of the equity markets. And then we're going to talk at the end a little bit about the FOREX market. Okay. I'm going to have Tyler come in. He leads our FOREX desk. We just opened that desk this year, and it's been a booming success. Tyler is at the top of his game in the Forex market. So he's going to give you a little taste of what the Forex market is all about. So I'm excited about him sharing that. Okay. But what we're going to be talking about is stocks. Okay. And what we're more specifically, what we're going to be talking about is how to get an edge, right? We talked about one of the most important things in the stock market or in your trading plan is you need to have an edge. I can tell you in life, being successful, you got to have an edge. If you're starting a business, what is your edge? What's your competitive edge? I mean, there's thousands of other people out there that want what you want. Okay. What's going to give you that edge over all of your competitors? Okay. And the market is the same way. You are competing against the professionals of professionals. Okay. The financial markets attracts the best, the brightest from the Ivy League schools. But I can tell you right now, okay, that doesn't mean crap. Okay. But the key is you're also going to be competing against, the computers, and, they don't deal with emotions like we talked about it again. So what we're going to try to talk about today is all in relation is how do you get an edge in this marketplace? Okay. How do you get an edge? Well, first off, you need to understand the 3 R's, okay? It's rotation, relationships, relative dynamics of the stock. See, stocks are grouped into 3 different types. There's different types of companies, which we're going to talk about. There's also grouped in relation to sectors. And it's also, stocks are grouped into relation to investing styles. See, one of the keys is to finding out what market are we in, right? And I talked about it before. The best way, or really, I guess, the most common way that you're going to find that a market dynamic has changed is through your P&L. Repetition. You should not have your P&L up when you're trading. Okay, you never have your P&L up on your screen. But when you're reviewing your trades, right? When you're reviewing your trades, when you start to see a different direction in your P&L, that's a good sign, if assuming that you're not making these mental mistakes, if you're really putting on good trades, then you're seeing a difference in market direction. What makes it so hard to trade is that you can come up with an edge today that's really, you're killing the markets and making huge alpha, your P&L is shooting through the roof. And then all of a sudden, one day, the market just takes it away. Right? And then you got to do it all over again. And you got to find a different edge, right? And because you're in a different type of market. So what we're going to talk about today is going to help you to really create these roadmaps on how do we know the market's changing? How do we know? Look, it's all about percentages. It's not about, you're never going to know 100% to be able to predict a market, to be able to predict a rotation. You're never going to be able to predict, tops or bottoms. That's fool's gold. Okay. You're never going to be able to do that. The key to trading is putting the odds in your favor. You must put the odds in your favor. That is the key. Does that mean you're always going to win? No. Does that mean that you won't have losses? No. You're always going to have losses. You must love losses, because some really of the best trading plans have more losses than gains. Okay. So again, put that out of your mind. So let's talk about types of companies. There's really 4 different types of companies. Okay. You have growth companies, you have value companies, you have defensive companies, and you have companies that are really income, dividend, yield driven companies. And let's go into those. Growth companies, that's the sexy style that a lot of traders gravitate to. That's the technology companies, the above average earnings, with potential to grow faster than the economy, right? They're typically the storied companies, okay? So, trying to apply fundamentals to growth companies, I see investors do it all the time. Now, it doesn't mean fundamental analysis has no place when you're trading growth companies, but, growth companies we talked about, remember, we gave you a good basis of stocks and bonds. A stock, you're an owner, right? And the board of directors in growth companies, are they going to really be paying out a dividend? No. Growth companies really are not paying out dividends because they want to take those earnings, they want to reinvest that money instead of giving it to you, the owner, owners, because you, the owners, are buying their stock for appreciation. You want to see that company growing exponentially. So when we talk about a Tesla, right? Tesla is not going to be paying, they're not going to be paying dividends, right? It's a story company. Is Tesla worth what they're trading from a PE standpoint? Are you going to be applying those metrics to a growth company? The answer is no. Okay. Value companies, a little bit different, right? Value companies are typically companies that are somewhere in the middle a little bit. They're kind of, they're relatively low to their fundamental analysis. Okay. They pay some dividends and some yields. Okay. But their stock price appears at a discount, right? It appears to be at a discount. Then you have defensive stocks. Okay. And these defensive stocks consistently are more, and that's the key word, consistent. Defensive stocks, are for the less risk averse investor. They're more consistent with stable earnings. Blue chip companies typically would be considered defensive. Okay. They're not going to move in terms of the overall stock market. Okay. They're more defensive. And then what you have is income companies that are typically bought for the dividend or high yield, right? Utility companies is one that comes to mind. A lot of older investors are looking for less, a fluctuation in appreciation. They're buying these utility companies because, hey, utility has a monopoly on the energy typically in their marketplace, and they typically will be paying a high level dividend. Okay, so they're looking for income. The second way that we have of really identifying and categorizing stocks is through sectors. Okay, there's 11 sectors in place, and this chart is important. So you have financials, you have real estate, consumer discretionary, information technology, industrials, materials, consumer staples, healthcare, energy, communication services, and utilities. And each sector has its, you have the business cycle, and you have some sectors that, if we're in the early cycle of the business cycle, market cycle, then, they typically perform better. Mid-cycle, late cycle, and recession cycle sector. So I love this chart. We pulled it. I forget where we pulled it from. We did get some notes on that. But, I love this chart because it kind of really puts in focus what sectors in the business cycle that you typically see these sectors do well. Now, within the sectors, you have different subsectors. So I want to break down each sector a little bit. Not spend too much time on this because you can kind of go through this yourself. Communication services, that's right there. It's broken down. You got diversified telecommunication. You have entertainment, interactive media services. You got the media, and then you got wireless telecommunication services. Under consumer discretionary, okay, you have, consumer products. You got autos, you got distributors, you got diversified consumer services. Hotels and restaurants are typically under here. You got household durables, leisure products. A lot of your retail and consumer spending companies would be found under this one. Now, consumer staples, when you're talking about consumer spending, staples are products that you need no matter what. It's not a leisure product. So you got the beverage companies, Coca-Cola, you got food products, Procter & Gamble, food and staples. You got household, personal, and tobacco companies. And then you got energy. Here's where you got your oil and gas, right? You got your fuels, you got your energy equipment and services. So energy, an important part of the market. Financials. So your banks, your consumer finance, you got your diversified finance, you got your REITs, you got your insurance, you got your thrifts and mortgage finance companies. So they would all be found under financials. So you got your, Rocket Mortgage, you got your banks, you got your capital markets, Square might even be considered under there. Healthcare, okay, healthcare, biotechs, right? So biotechs, we're going to get into biotechs, when we start talking about the different types of trades that you can do, and you're doing product launches, and the FDA and the levels 1, 2, and 3 as far as product development you can play some good biotech companies, healthcare equipment, healthcare providers, life sciences, pharmaceuticals, that's all healthcare. Industrials, okay? Here's your Boeing, aerospace, your airlines, okay? You got your electrical equipment, machinery, professional services, all under industrials. Then you got your informational technologies and your materials. You can kind of go through there. You got your IT, cloud would be under informational technologies. Cloudera, you got your cloud, software companies, all going to be under informational technology. And then finally, we got real estate, your real estate companies, and your utility companies would be under the utility sector. So make sure, it's another way of grouping stocks. It's another way understanding, in our playbook, we put, what sectors are hot, what sectors are not. So definitely, when you check out our playbook next week, make sure that, you check out the sector section, because, and you can see some rotation in there. You can see some relationships in there. So you want to know what sectors are really in play and what sectors are not in play, because you want to be trading, again, sectors that are in play. Now, you also have two different types of investing style. And you hear this all the time, growth versus value. And you have periods of time where growth is in vogue, and then you have periods of time where value is in vogue, right? So, growth companies typically, they're typically trading at higher PE multiples. Remember what I said before, growth stocks are typically storied stocks, okay? Stocks that have a story. I remember when Amazon first came to the marketplace, right? That's when I was first trading. And Amazon, to me, I consider that the best company that you could invest in out there. I'm not talking about overall return. I'm talking about the best managed company. They have a monopoly on what they do. They have single-handedly destroyed other retail companies, right? And they're getting into healthcare. They're getting into other industries. So Amazon, when it first came to the market, for years didn't make money. Years. And where did the stock go? It went up. In growth companies, it's not necessarily about the fundamentals. Stories are the top, right? Does the story make sense? Right? And so, growth companies, during tough times can do particularly well, right? Because they're taking their money and they're not expecting to produce that income right out of the gate. They're, investors are looking at, what are margins? How are they executing on their story? Okay. Again, Tesla, right? Tesla was just going through the roof, and, especially over the last couple of years. And the story was Elon Musk. Okay. Was Tesla profitable? No. Okay. But Tesla, the stock was insane. Again, growth companies, you're not going to really, you're going to see some outrageous PEs. Look at Zoom. Okay, Zoom, when it was trading at even where it's trading up now, it's trading up to $500 a share. If you go look at the PE of Zoom, and I don't know what it is, but it's insane. Right? It's a storied stock. We have COVID, no matter what, with this vaccine is a fundamentally changing story that is going to change how the public really, how it goes about business going forward. It doesn't matter. Once we have this vaccine, it doesn't mean everything's going to go back to normal. Okay. So Zoom, if you were trying to look at the PE of Zoom, you would never have invested in Zoom. Okay. It's a storied stock. And the story, what is the story? It's a COVID story, right? It's a fundamental changing story in that, it's kind of like how Amazon was. Amazon, the internet, right? The internet was another fundamentally changing story. Back in the early 2000s, the .com, what really pushed the market was the fact that the internet was fundamentally changing the marketplace. So you had any stock that had a .com behind it was fundamentally going up. It didn't matter what they were. I mean, it just, it didn't matter if they had earnings or not, just because it had a .com, because it was part of the story, right? And the internet was a fundamentally changing story. So Amazon, okay, is the best example of that, right? And Amazon fundamentally changed retail. You see all these box stores closing because of Amazon. They can't compete because now Amazon, we've created they've taken over and monopolized a whole new marketplace that is global and not just limited to a box store where people can actually physically go into the store. Well, it's the same thing with Zoom. Okay. And yeah, do I feel that Zoom is going to be dropping back a little bit from its lofty valuations? Absolutely. But you know what? We have another fundamentally changing story, and that fundamentally changing story is COVID and how people are going to go about their life and how they're going to go about business. Stay at home is not changing. Working from home is not going to just completely go away. More and more people are going to be seeing the value of having, employees working from home. Okay, that is important to understand. So just like you see comparisons, you say, well, the .com, everything was going up, valuations were crazy. Well, that's why everybody compares 2020 to 1999 and 2000, because we have another fundamentally changing story. Now, eventually the bubble will burst, the euphoria will burst. And I'll give you another example. We actually, when we had the software, what's it called? It's you had the blockchains. And everybody was looking at blockchains, right? And any company, that small company that had blockchain or had something to do with blockchain, you saw companies that were doing something else, and all of a sudden they threw blockchain in their newsletter, and now they were going up because investors want to be part of blockchain, right? And blockchain was maybe not the extent of the internet, maybe not the extent of what we have with COVID, but you had a little growth spurt there in companies that had blockchain. So be able to have a top-down approach and be able to see these relationships, these stories, these patterns, that's important, right? It's almost, look, I'm old school, and a lot of people haven't heard of Peter Lynch. Peter Lynch back in the 80s, he was the guy that he was like the Warren Buffett guy, of where he would be like, look around, investing, trading, look at companies that have a story. Look at companies, you're going to the store and everybody's wearing Crocs, then maybe you should look into the Crocs company. Have an open mind to your environment, see what's happening, because the sooner you can understand these relationships, the sooner you can see some of these stories, the better off and the quicker you can get in the beginning of the wave and profit from some of this, okay? So you have a lot of people with the stock market going through the summer, made a lot of money because they were able to identify, they weren't looking for the market to fall back. You had a lot of people through the summer that didn't participate in the wave we had. Why? Because they couldn't have a top-down approach to look at the story. They had their own biases of, why is the stock market going up at all-time highs when we have this COVID, this pandemic? People are dying. The economy sucks. Man, the presidential election. Okay, if you get stuck in all those biases and all that bullshit, okay, you're never going to make money. Okay, you truly have to be able to see some of this. Now, value, lower priced, stocks, we talk about what is a value type market, what are value stocks, right? We talked about it. They're often, sometimes you're going to see a rotation from growth to value and value to growth. Well, value stocks are stocks that have been beaten down. If growth stocks are typically running, what's happening to value stocks? Value stocks are typically dropping. They're not in favor. There's only so much demand. It's all about supply and demand, okay? Understanding trader psychology. And we're going to really get into that next week. And when we talk about charts, we're going to really talk about trader psychology. You need to understand trader psychology. You can't just look at a freaking chart and think, oh, there's lines. No, you got to understand the psychology behind it, not just the action, right? So value stocks, growth, everybody's jumping into growth, buying growth. Where's the demand? Demand's in growth. Where's going to be the demand in value stocks? They're not going to be there. So what's going to happen to the price? They're going to drop. Okay, so demand, where people's focus is, that's where you get that rotation. And so value stocks are typically those stocks that are, stronger stocks, blue chip stocks, more stable stocks. They actually have fundamentals. And according to their fundamentals, according to their PE, they're trading at a discount. Okay, back in the 80s when we started talking about, early 80s, when we were talking about all the takeovers, Michael Milken and all that, value stocks were in play, right? It's before growth really became a thing. And value stocks, man, they were buying stocks that had cheap book value, tearing them apart and selling off the pieces, right? It's because they were based on a fundamental value. And if you look at, you can kind of see this chart kind of shows you, growth to value, right? You can kind of see through the different years where, growth was compared to some value stocks, right? And you want to be able to know what's in favor. Because see, the market environment, like I said, is always changing. So you want to understand where is the demand. And that's what rotation is nothing more than where is the focus, the spotlight for the majority of traders? Where is the demand for stocks? And you can have rotation on an hourly basis. You can have rotation on a daily basis. You could have rotation on a weekly or a monthly basis, or you could have rotation for years. Okay, it really, you have to be able, though, to tell where is the spotlight, where is the demand. You don't want to be caught in the wrong market environment with the wrong strategy and thinking you have an edge when you don't. Okay, I'll give you an example. This vaccine news that came out from Pfizer was a fundamentally changing event. Now, I'm a little cautious on it because having traded biotech for so long, typically it takes 10 years to get through a new drug launch. Right? They're trying to compress this 10-year process into 6 months. So, anything could happen. Tomorrow, they could now have bad information that could delay the launch of the vaccine. But, on its surface, it appears that this vaccine news is a fundamentally changing news, because if this is true, right, now the pandemic will be over. Okay. But again, remember what I said, it doesn't necessarily mean the story, there's not going to be, the story's not going to change, right? There's still going to be stay at home, but you as an investor got to figure that out, right? What is going to be that new dynamic? But now, ever since we had that vaccine news, right? Ever since we had that vaccine news, we've seen a rotation. Now, prior to, up through the summer, up through the election, we would, it was really a growth stock market, right? And you would occasionally see this rotation based on some news or something into value stocks. But typically it would only last like a day, or maybe it would last 2 days, right? But it was important, it was really profitable to understand and see that rotation. And I'll talk about how to really, understand and see that. But now, ever since we had that vaccine news, we did see a rotation into what we like to call the trash stocks, the beaten up stocks, the value stocks, right? And but then, again, it lasted for a couple days, right? And then it kind of went back to tech for a little bit, but then, it's kind of going back again, right? So value, we believe now, is a little bit more in focus, but you got to be careful with value, because people started jumping in AMC, right, in that rotation, AMC Theaters. Well, AMC Theaters just a couple weeks prior was engaging bankruptcy attorneys. So they still got problems. Airlines are not going to change. They were going up, but they're not going to change overnight, right? So we started seeing a rotation in airlines. So you got to be careful. It doesn't mean all systems go on that rotation and that these stocks are just ready to go and take off, right? So you got to be careful. These stocks have been hit, and they've been hit for a reason. But remember, the market typically is a forward-looking market. So you got to understand, how's this rotation going to hang up? And, typically growth is technology stocks. So how do we kind of see some of this? Well, we saw the QQQs. All you got to do is look at the charts. The QQQs over the last week have really lagged, while we see the small caps, IWM, has really led the way. Okay, through the summer, who was the leaders? Okay, the leaders were who? It was really the tech stocks, the growth stocks. So, and that brings us up to the other part, which is relationships, right? So it is so important. If you've been following our afternoon show and our morning market analysis, which I recommend that you catch both of those, okay? You know how to identify market generals. You know how important market generals are to making money. I got videos on here. I showed you the last class to go look up on how to, how we used, Apple is a market general, how we used Apple to trade the SPY. Right. And very profitable trades. I mean, we made 100, 120% in like minutes on just watching the market generals on, with in relation to the SPY and understanding that relationship. So and again, the market generals are constantly changing. The key is, how do you find who a market general is? Well, who's leading us out? Is tech leading us? Is growth leading us? Who is the leaders? Right? And you got to find, and what I liked about Apple and Tesla was really one of our market generals. See, to me, Apple is a great market general because it's institutionally owned, right? And you got some institutions in it, you got retail traders in it. It works as a really good leader. Tesla was really good for many, many months as really what I call a sentiment leader. It wasn't necessarily a price leader, but you had that FOMO. Like Apple, it's different than Tesla. Apple's got earnings, established products, and established pipeline. They're a little bit more mature as far as a tech company is concerned. Tesla is still what I consider, it's out of the infancy stage, but it's still a newer, trying to find its footing as far as a profit standpoint. So it's more of a FOMO. Do the traders have FOMO? Are they willing to put risk on? So you want to have the leaders to really that are going to tell you, hey, traders are okay with risk right now. Okay. And so that's where I have to look at some of these. You got to have these stocks up there that who the market generals are. Then you also got to know who the sector leaders are. What are the what stocks are you looking at to tell whether that sector is really catching a bid? Okay. So, and if you're going to invest in the stock in that sector, you got to have a top-down approach, right? You got to look and say, okay, what's the market doing? Because I don't want to be buying a stock necessarily if the market's not strong. What is the sector of the stock I'm doing? What's the leader in that sector doing? Because I may not want to buy a stock that the sector's not in favor. Not all the time. Okay, so a top-down approach. What's the market doing? What's the sector doing? What is the leaders doing? And you want really the odds in our favor. So we want all these things to stack in our favor. It's just like when we look at charts and you look at multiple time frames. I'm going to teach you that, right? You should have all of the time frames going in the same direction. There's a reason for that. Okay, so who are the sector leaders? And then you got to also understand intermarket relationships between asset classes, right? Bonds to stocks. Let me ask you a question. Again, it's all about focus, supply and demand. Typically, if bonds are shooting through and bonds are running, right, and bonds are hot, then typically, traders are going to be in bonds. You may see the portfolio ratios a little higher in bonds than the stocks at sometimes, and stocks may lag, right? What's gold doing in relation to the dollar? Okay, understanding those relationships. Typically, gold goes up when the dollar falls, right? What's the relationship? Commodities. Are commodities rising? Well, if commodities are rising, guess what that may do to inflation? It may point that inflation is going up. Well, inflation, we're expecting possibly having more inflation. What's that going to do to certain stocks? And then, of course, looking at currencies, understanding currencies, and currencies really affect all asset classes. And so that's why, even if you're not going to trade FOREX, it's important to understand the relationship of currencies, right? But sometimes you got to be careful. Okay, sometimes you got to be careful because sometimes we have what's called a decoupling of relationships. Okay, and a decoupling, we have black swan events that could signal a decoupling, right? Black swan events are events that are just like really negative events that market did not anticipate that could be a fundamentally changing event. 2007 was a black swan event. Okay. And, a lot of investors, I'll give you an example of a black swan event in 2007. Okay. A lot of investors invest in money market funds, and a lot of investors consider money market funds to be cash. They are sold by brokers as 100% risk-free cash. Get your 1-2% and put it in a money market. Why keep it in the bank? Okay, it's all bullshit. Okay, most of the brokers that are telling that crap is actually lying. Okay, but the SEC doesn't do anything about it. Everybody's doing it. They're all considered money market funds to be as safe as cash. Well, guess what? And the key with money market funds is they're always priced at $1. Okay, because they're investing in government-backed securities and stuff with swaps and bank swaps and notes and stuff like that, and they're considered secure because of the relationship to those type of assets, guaranteed by the government and stuff. So they're not appreciations like you get your 1-2% through interest rate changes, and so what happens is it's always priced at $1. Okay, but what happened in 2007 through the financial crisis? People don't realize how close we were to collapsing as a fundamental economy. Okay, it was the first time ever, this is a black swan event, that the money market funds broke $1. Okay, first time ever. Well, think about back in the 1920s when we had our depression and the market crashes back then. You had what was called a run on banks, right? Well, we were close in 2007 to seeing the same thing. There's a couple really good documentaries to go into it. But had Paulson and had Bush not done what they did back in 2007, and we can talk all day long about risk and who should have been bailed out, not who shouldn't have been bailed out. But all I can tell you, I'm not going to get drawn into that conversation. All I can tell you is if they didn't do what they did, the financial system as we know it was had a possibility of completely imploding and collapsing. Okay, so that is a black swan event. Okay, a pandemic is a black swan event. Another one was back, I think it was in the 90s, Long-Term Capital was this huge, way huge, really big money management firm that, took two big bets and really was in danger of imploding the system. That was a black swan event. Okay, that I've been through. So the point is, black swan events typically have cause a decoupling of the relationships that we typically look and use as our guides. So, and the reason for that, and I don't want to spend too much time on the reasons, but a lot of it is, you had the Fed come in. So the Fed came in 2007, you had the Bush and Paulson, came in and cut some deals. My old firm, Lehman Brothers, an institution from the 1800s was one of the casualties from that, right? Bear Stearns. But the point is, when the Fed comes in, the Fed is really coming in and providing a underlying support to the markets. They're providing liquidity, cheap available cash to companies and to the financial institutions. So you heard of the Fed put, you heard of, don't ever fight the Fed. It's true. Right. So a lot of people that have these thought process of, we should be crashing through the summer. The fundamentals are horrible. The market's horrible. Right. A lot of that stuff is true. But the reason the markets don't care is because risk has a floor. It's called the Fed. And the Fed is not going to let companies, die. It's not saying that companies, aren't going to go bankrupt and all that other stuff. It's just that they're putting a floor to the institutional money, to the institutions that are really putting, that keep the underbid in the market. It's not us, retail traders. So the Fed is providing that liquidity, that cheap money that companies now have access to and can make money on. And, the access is almost typically unlimited. And even this go round, you have the Fed stepping in and buying securities. Okay, so you know, why are you fighting that? That right there kept the bid, it took the risk away from the marketplace, from an institutional level, and you know, it caused that decoupling. So now you see bonds that were doing good. Now you see stocks are doing good at the same time, when typically you have a different type of relationship. So you need to keep that in mind. Don't ever fight the Fed. And now, of course, you know, we can, for a talk for later, is now the markets kind of have a you know, they're kind of hooked. It's like heroin. They're hooked on the Fed. And then what, you know, the key going forward is that it's going to decouple again. And eventually things are going to change. And so now, where bad news necessarily really hasn't killed the market, you know, now all of a sudden you're going to see a change that eventually good news may become really bad news for the market action. Because now, you know, once we get healthier and the market gets better and the economy gets better and companies are getting better, you think that's a good thing for stocks. It is, but the market kind of goes through this, like just when you take a heroin addict and you get them off of the heroin, they have a rough, bumpy time in the beginning, right? Well, the market, same thing. It's interesting that I'm doing a class and I'm comparing the market to heroin addicts. It's, you know, I'm kind of screwed up, but that's, you know, you got to be a little screwed up in the mind to be a good trader, right? But it's the same thing. It's the same thing, right? So eventually what you got to start looking for is we're going to start seeing good news become bad news. And I start, you know, we were trading short that Monday. We were trading short the Pfizer news. The market faded the whole day because I was basically putting out there, and no, I didn't see anybody else saying this, but if we got a vaccine, the pandemic's going to be over. And so what's now the impetus to do a stimulus package, right? So, you know, you got to be careful. Really good news can be bad news at some point, right? And then you're going to have to be careful because in the market, you know, it's going to be like that heroin addict. It's going to have, you know, getting off that heroin. It's going to be, man, it's going to, you know, really sometimes it's going to go down on good news. So you got to be on edge looking for that. Unless you've traded through this, you don't understand that. That's why we're your mentors, you know, use our experiences. We're going to, you know, our group going forward, you know, we're going to have a group, you know, again, no charge, you know, but we're going to have a mentor group and, you know, we're going to have that out there. We're going to put it out there for you guys. You know, start looking for stuff like that because you got to, you know, unless you've traded through it, you really don't understand the signs and what you're looking for. So there will be a decoupling again and relationships will change and good news will be bad news and the market may get hit on some of that. So, you know, just follow our lead, but you're going to want to understand. That's why it's important to take notes because you know, history has a rhyme to it. Doesn't necessarily repeat, but I think Nick says this all the time. History has a rhyme. And so you just got to follow that rhyme, right? And so with the Fed, same thing with the Fed, you know, make sure that you are watching that. So the next section that I want to talk about, you know, is the relative stock dynamics, you know, to understand relationships and understand the stocks that you're trading. So I kind of want to switch a little tactics. One other thing on relationships, by the way, so relationships can change. When I started trading and all throughout, you know, I've been really, you know, tied to the yen, right? Because believe it or not, the yen and the market had an inverse relationship, right? And, you know, that relationship through the years has kind of dissipated. You don't see that as much because the international market has changed. Oil, you know, oil, I don't care what happens to all of these electric vehicle companies, but oil needs to be above 40, guys, okay, to have a strong, consistently up market. Oil needs to be the driver to a consistent market. But with all these electric vehicle companies and the alternative vehicle companies, is that relationship kind of slowly fading, going to change? Banks need to be strong, in my opinion, right? That's always been the opinion in the past, but is that going to change? Okay. So that's it on relationships. Again, you know, you got to filter out, you got to take notes, you got to figure out, how am I going to know when there's market turns? How am I going to know, you know, to get that edge? Now, look, as we go forward, now you're going to have to start slowly identifying, okay, what stocks am I going to trade? Okay. And in doing that, you got to look at some of the relative stock dynamics that you see in stocks. right? And so, some of the things you want to take a look at, and we'll get more into this in more detail as we go forward, is, what's the ATR of a stock? Okay. The ATR is the average true range. And you want to know, a lot of times I get people give me stocks, let's trade this, let's trade that, but the ATR is not there. So I was like, how am I going to make any money? Right. I'm in the day and out. So I may not want to trade that stock. You want to know, and something that's really important and a forgotten tool that people look at is volume. Okay. Volume is so important, and people just ignore volume because they don't understand it. And there's a tool that really works well, is knowing what the relative volume is. It's called RVOL. It's what professional traders look at. So you want to make sure, to me, volume is demand, guys. How do you really quantify demand? It's volume. And to get a stock to move, you need what? Volume. Okay. So when we're talking about, volume and demand, RVOL is important. Okay, and we'll get into that. Float, okay, float is important. What's the float of stock? Okay, is it a low float stock? Is it a high float stock? Because a low float stock, limited supply, could really, you could have, some investors that could actually manipulate and move a stock. Typically, you can't manipulate and move a stock. And you're also going to want to know, what's the percentage of institutional ownership? What's, you can see, there's services out there to see what is the percent that the institutions own this stock. Now, why is that important? It's important because, it's typically a more stable stock if you have heavy institutional ownership. But it's also important because you have the market makers that, really can play some games with you from a stop loss standpoint. Okay, if you've got a lot of institutions in the stocks action typically works a little bit differently, and we'll get into that. What's the percentage short interest that's in the stock? And I'm going to go over shorting next. But how many people are shorted the stock, and how many days does it take to cover that short? That could have an effect, on a stock price. And then, how does it trade? When you're talking about relationships, there's no better relationship than trading the same stock over and over again. Why? Because you get to know the character. Each stock has its own market maker, and each market maker and traders trade differently. Okay, so yes, stocks have their own characteristic. I'll give you a perfect example is Roku. Roku has a characteristic that I trade all the time. I know that with Roku, there's certain times that I could trade right off the opening print and get 5 points within 1 to 2 minutes, and I'm done. And I would never know that. I would never do that in any other stock. It's because I know the character. Right. And I know that, if you go back and look at the openings on Roku, man, I could really ride that ride. But, I only know that because I trade it all the time, and I know the character of Roku, and I know how it trades. So there is something to be said about having some core basket of stocks that you can trade over and over again. Okay, let's talk about now, when we get out of relationships, let's talk and finish up this section on let's talk about, ways to trade stocks. I'm going to, get into that. And then I want to get in, explain a little bit of shorting as far as that's concerned. And then, we'll get into some options, and then I'm going to get into FOREX and, kind of get you guys moving along here. 2 ways to trade stocks, right? You can buy them or you can sell them. Okay, there's what's called long, and there's what's called short. If you're long, you are considered to be bullish. Okay, if you were short, you're considered to be bearish. And bulls, bears. Easy way, if you're really don't understand that concept, which I don't know how you can't. Bulls have their horns point up. So if you're bullish, you want the stock to go up. Bears typically have their paws pointed down. So if you're bearish, you want the stock to go down. So, 90% of the traders, especially beginning traders, they think there's the only way to make money is to buy the stock and buy it low and sell it high. Right. Of course, we talked about, some of the beliefs and stuff like that. Well, one of our beliefs is you may want to have a belief that you buy higher and you sell higher. Right. And it's called momentum. But, again, you buy at a lower price than what you sell it. That's a profit. Now, what about though if you think the stock's going down, you just ignore it? Well, not professional traders, because professional traders, they do what's called shorting a stock. And shorting stock, it's really easy. And let's kind of get into that. So let's say you think a stock is going to go down. Let's say you think Apple's going to go down. So what you do is you do the exact opposite. You kind of reverse the order. What you're doing is you're taking shares of Apple, you're selling them high because you think it's going to go down, and then you're buying them back at a cheaper price. Well, how can you do that? You say, Mike, what are you talking about? I don't understand that. Well, let's say that you think Apple's going to go down and you come to me and I own Apple. You say, Mike, I'd like to borrow your 100 shares of Apple. I'll say, okay. I'll tell you what, I'll lend you my 100 shares, but I'm going to charge you an interest rate for that. You say, okay, no problem. And so what happens is I lend you my shares of Apple. They go into your account. And then what do? You then sell those shares, right, in the marketplace. So let's say Apple, let's say Apple is at $10 a share. Okay, you sell your 100 shares of Apple. Now in your account, you receive $1,000 in your account, right? You got $1,000 in your account, but you also owe me 100 shares of Apple. You got to eventually pay me back. Okay, so what happens is, let's say Apple goes down to $9 a share. Okay, you say, you know what? All right, I'm going to go back now and I'm going to take that $1,000 and I'm going to buy 100 shares of Apple back at $9 a share. So how much is that going to cost me? It's going to cost me $900. So I get those 100 shares of Apple that I just bought. You buy those shares, you give it back to me, right? Minus, and again, you give me the shares, so you don't owe them to me anymore. And in your account is the difference, right, of the $100 minus any return, any interest that it might have cost you for me to lend you those shares. So that's an example of shorting. And typically you don't have to go to a person to do that. Your firm, right, the trading clearing firm that you're using will lend you the shares. And let me kind of explain that a little bit more. See, when you buy stock, right, you have the right, I talked about this before, to actually get the certificates. Do you have the right to get and receive your stock share certificates? You absolutely do. If you want to take them and store them and put them somewhere, because they're actually currency. Okay, that's the proof that you own Apple. But most people, they sign off and say, no, I want the brokerage firm to keep my stock certificates and hold them safe and secure for me. Okay. And it's easy when you're buying and selling stock, because then you don't have to send the brokerage firm, the clearing firm, your certificates and all that other crap. Right. So 99% of people don't get their certificates. You sign off when you open your account to have the firm hold the certificates. You also don't know this, a lot of people, because nobody ever reads contracts, but you also typically sign off that you allow the firm to lend your shares out to other people. And you allow the firm to lend these out so people can short a stock. Okay. And so what happens is, if you want to short a stock, your broker typically is the one that's going to, your clearing firm's the one that's going to lend you those shares. Now, is every stock shortable? The answer is no. Okay. Every stock is not shortable. Okay, so typically when you have your clearing firm, and some firms are better than others, you want to see if they have an inventory. And some firms may only have a low amount of shares in their inventory account. So you got to be careful with, if you want to do a lot of shorting, which clearing firm you sign up for. That's important. Typically Interactive Brokers is a good firm for inventory if you're doing a lot of shorting of low price stocks. Okay, historically they have a good inventory of stocks. Another thing is, this is why you got to really have a schedule. You got to get up early, because if they have a stock you want to short, it's one of those low price gappers that are doing going up for dog shit manipulated news, and you want to short those shares. Well, guess what? If they only have a short inventory of stock, the early bird gets the worm. You got to put in typically and say, hey, I want to reserve let's say 1,000 shares of this stock to short. If you don't do it early, there's a good chance they're going to come back and say, nope, we don't have any more shares left, or they may not have any inventory at all. So not all shares are shortable. Now, a lot of the big cap and a lot of the bigger stocks that have a huge float, typically you'll see what's called a little E, okay, next to your symbol, and that means easy to borrow, and you don't have to reserve shares. Okay. But even then you got to be careful because, in the stock market collapse in 1987 and, when we had the market, Black Friday and the market went down the largest it's ever gone in one day back then, you had a lot of people that were shorting stock into that, and it caused a real liquidity flow crisis. So what they created was some rules, okay? They came out with some rules, and one's called the circuit breaker rule. And so occasionally, if you see a company that is easily shortable, and you see that company going down pretty dramatically, and you want to short it, you may not be able to. The key is you'll see what's called a CB next to that E, next to your symbol, and that means circuit breaker. And what that means is you can only short on an uptick, which means it has to have gone up a green uptick from the previous trade for you to be able to short that stock. And a lot of people don't realize that. They're hitting their hotkeys and they're unable to short, and they don't understand why they're not able to short. Okay, so there's some interesting things you got to worry about with that as well. So the answer is, who's lending you those shares? It's typically your brokerage firm. Do you have to pay interest on that? Technically, yes. And it requires, a margin account, right? Because again, you're technically borrowing shares. So you are in shorting, you want the stock to go down, you're bearish, you're selling high, then you're buying back lower. Okay, so that's important to understand. You can only do them in margin accounts. Now, shorting, again, there's extra cost to that, locating shares. We talked about that. You got to be careful because if the stock pays a dividend while you're short, then you may have to pay that dividend as well back to the lender. So you don't want to, keep that money. And then we talked about, we talked about Regulation T, which means, you must have 150% of the value of the short when you initiate that. And again, the reason is because the risk is infinite. Because think about it, if you think a stock is going down, okay, and you sell it at $10 a share, and then it comes out with news, right? Because you have to buy those shares back, and it comes out with news, and all of a sudden it shoots up to $100 a share. Well, what happens? You have to buy it back at 100. Okay, and theoretically, it could go to infinity. So your risk is unlimited. Shorting is very dangerous if you don't know what you're doing. You can blow out your account in a heartbeat, because what will happen in your margin account, you're technically borrowing money, and they have what's called a margin maintenance requirement. It's different, it's different when FINRA sets it. It's different per the seasonality. It's different per brokerage firm and clearing firm. They all have their different margin maintenance requirements. And what will happen is you may get what's called a margin call, and you may have to buy those shares back now, no matter what, or they may force, and they have the right to go in and buy those shares back for you, no matter what. And trust me, you're not getting a good price, because the investor firm, the clearing firm, is trying to reduce the risk on your account. So you can blow your account out on a margin call. And I'll give you an example. Back, we had a fund that was shorting volatility. Okay, and we were shorting volatility. It was really, for about 3 years, shorting volatility was a crowded trade. You had, people at Target. I was running people at Target that were actually shorting volatility. It was a crowded trade. It basically, we'll talk about volatility. You're shorting the VXX. And we had a fund that, we had investors who were making 150% a year just shorting volatility. Then all of a sudden, in one day, you had a volatility squeeze in the pre-market hours, and margin calls came out all over the place. And so you look at the chart of the VIX, you can see that, you see that spike, right? But even though the volatility wound up coming back down, it doesn't matter. People weren't able to hold, because they got margin called out, And in that short period of time, that short spike, they got squeezed out. Now, to some clearing firms will allow you to alleviate a forced cover by depositing additional capital into your account. But some of them won't even do that. If it happens after hours and you don't respond to them, they may just force liquidate your account and blow your account out. So shorting, there is some unlimited risk there. So you do have to be careful. Make sure you know what you're doing if you are shorting a stock, and especially if you're holding in after hours and holding it as a swing type of trade. So that is it for the first part of our class. That was equity options, relationships, getting a market edge. What we want to do, we got two things left that we want to talk about. I want to talk a little bit about options, okay? And I'm not going to go into great detail on options because I am going to do a options class specifically just on options, probably be a 2-hour class, and it'll be a little bit more detail oriented, but I want to introduce options. And then Tyler's going to finish up and really get into FOREX so that you guys can understand the FOREX market, because as we get into next week, and this is the reason I'm introducing options here, as we get into next week, you're going to get to start to know yourself, know your risk, and know what, you're going to have to start picking what type of markets you want to trade. And even if you've traded markets before and you've traded before, I want you to go through this process and have an open mind. Okay, that's the key with this class. Have an open mind, go through this process as if you know nothing. And so, when we get into next week, you're going to start figuring out, because one of the keys to being a successful trader is figuring out what securities to trade, what strategies to trade that fits your personality, fits your strengths, and also is good with the weaknesses that you have. And everybody has different strengths and different weaknesses. And I can't tell you how many times I see traders that come to me for help and they haven't even thought about this, and they're trading stocks that is completely against their strengths and is not in alignment with their weaknesses, and they wonder why they're losing money on a consistent basis. So what I want to do here is I want to introduce options to you. I am the options guy on our trading desk. I'm the fund manager, but I also, I kind of hold options near and dear to my heart. I've traded lots of complicated option strategies. I know options like the back of my hand. So what I'm going to try to do is just give you a quick brief introduction to options. And even if you're not going to trade options as one of your assets going forward in your trading plan, it's good to know. They are good to know because they can really help you identify the relationships. Okay, when we talk about relationships and what markets are doing, it's good to help identify when risk is on and risk is off. It's good to help identify, sentiment, and it's good to identify players that for a stock that may be in play and for to maybe an earnings event. Okay, so let's get into options and let's talk about them. First off, options, really, you can talk about options all the way back to ancient Greece. They used to speculate on the olive harvest, right? And so, there would be options, in its purest form that the ancient Greeks would really use to protect themselves against bad weather and the olive harvest, because it was like 90% of their life of how they made money. And then, the infamous tulip growers bubble, tulip mania. If you don't know anything about that, Google. It's really, we don't got time to go into it, but you had options played a role really back in the tulip mania as well. Now, options kind of had a bad rap. London banned options for like 100 years, up until the 19th century. There was a lot of corruption and, risk and stuff like that. And that's really, options in its earliest form. You got really options as we know it today, first started back in the 70s. You had Russell Sage, he was really the first person that started talking about calls and puts in an unregulated form. You have the Black-Scholes model that I don't think a lot of people really use anymore, that got the market really comfortable with pricing and understanding value of options. You're going to hear a lot about the Black-Scholes model, which a lot of professional options traders have kind of moved away from nowadays, because options has evolved. I mean, nowadays you got millions and millions of contracts that are traded each and every day. And so, when I first started back in the 90s, there, options were, a little bit different, right? And you had spreads were pretty wide, and people just didn't understand options. And then, as they've kind of have evolved as we've gone on. So what is an option? Okay. First off, there's two parties. Okay. There's a buyer and a seller. Okay. And what happens is options are nothing more than a contract between two parties, between a buyer and a seller. Now, the seller is the person that writes the contract. They're considered the writer. Okay. And so what happens, obviously, if they're selling, then the buyer is going to have to pay a premium to the seller. So if there's a contract here, and the seller, the writer, is creating that contract, they are selling that contract, and they're going to receive money from that contract, right? So and that's in the form of what's called a premium. Okay, so the buyer pays the premium, the seller is going to receive the premium. Okay, now let's go back to stocks. Let's say that you are really bullish. Okay, horns pointing up. You're bullish on Apple. Okay, and you want to buy, well, and let's not even say Apple. Well, now let's say Apple. Okay, you're bullish on Apple. But to really make money on Apple, you would have to pay 100. You have to actually have 100 shares, buy 100 shares at least of Apple. And let's say you're in college, you don't have that much money. Okay, and to buy 100 shares of Apple, and I think it's currently trading at 116. Let's say it's trading at 120. Okay, Apple's trading at 120. Well, you're gonna need $12,000, right, to buy Apple. And say you don't have that. Okay, well, what you can do instead is you can actually get a contract, buy an option on Apple. Okay, and what it is again, an option is a contract between two parties. Okay, where the buyer is going to have a right to do something. Okay, which means if the buyer has a right, then the seller has an obligation. So let's say that you want to buy an option contract on Apple, and you want the right, you think Apple's going up. So you want to lock in what's called a buy price, right? To be able to have the right to buy 100 shares of Apple, okay, for a set period of time. Okay, well, the person on the other side, the writer, says, okay, you know what? For $2, I am willing to give you 30 days, okay, to buy Apple at 120. Okay, so no matter what, okay, during that 30 days, you have the right to buy Apple at $100, 120, excuse me, 100 shares. Okay, so again, the buyer has the right. The seller has the obligation. So who's taking risk here? They're both taking risk. The seller, though, has the most risk. Technically, it's kind of looking like it's like the short situation, right? The seller, has to sell 100 shares of Apple at a price locked in the contract at $120 a share. So the seller, technically, if Apple goes to 500, has to go get those shares and sell them to the buyer at 120. So technically, the seller has unlimited risk. The buyer, however, has the right, which means, do they have to buy Apple at 120? No. If Apple drops to $1, do they have to buy Apple? No. But, they paid that premium. So really their risk is related to the premium they're paying into the contract. Okay. See, each contract is based on an underlying security in the market, and each contract, one option contract, controls 100 shares. So each option contract, so if you buy two option contracts, how many shares do you control? 200. So if you see a premium, that's a premium of $2 a share, okay, $2 for that option contract. Well, it's each option contract controls 100 shares, so it's in hundreds. So you don't pay $2 for that option contract, you pay 200. So if you buy 2 option contracts with a premium of 2, then you're paying $400. Does that make sense? Excuse me. Yeah, $400. Okay, because you control 100 shares, so it's in hundreds. So if the premium is $2, it's a 200 per contract per 100 shares. So if you're buying 2 contracts, you control 200 shares. You got to buy 2, and the premium is at 200. That's $400 it's going to cost you. Now, there's 2 types of contracts. There are only 2 types. Real easy. It's calls and puts. That's it. Calls and puts. Okay? It's the 2 types of contracts we have. Now, if you're a buyer, okay, if you're a buyer and you think the stock is going to go up, okay, what can you do? Okay, well, you can buy calls, okay, because calls give the buyer the right to purchase a set number of shares for a set time period at a set price. So you are locking in a buy price with a call contract if you buy one. So if I'm buying an Apple call contract, because I think Apple's going to go up, I'm locking in a buy price, right? That's just what we call the strike price. And I'm locking in it's going to have a maturity date. Okay, and I'm going to pay a premium for that. And there's going to be, there's that strike price, which is how much you're going to have to pay for that. So if you think a stock's going up, you buy a call. So the seller obviously thinks the stock is going where? Down. And they receive what's called money in the form of a premium. So the buyer pays and the seller will receive the capital. Now, a put contract, if you buy a put contract, okay, a put contract basically gives you a right not to buy at a set price for a set period of time. A put contract gives you a right to sell 100 shares at a set price for a set period of time. So if you think Apple's going down from 120, then you wouldn't buy a call. You don't want to buy in a right to buy. You want to buy in a right to sell, which is a put contract, and it's going to lock in a sell price. So it's just like that shorting example we talked about. So if you were to buy a put on Apple and you buy it at let's say 120 strike price, if Apple goes to 100, you've locked in a price to sell Apple at 120. Okay, so the seller has an obligation to buy that stock, right? Where with calls, you have a right to, so let's go back to a call contract, okay? A buyer has a right to buy the stock at a set period of time. The seller has an obligation to sell that stock, okay? A put contract, you have a right to sell the stock at a set period of time for a set price, which means the buyer, they're the ones that have to buy the stock at 120 at that set price. Okay, so if Apple goes down to 90, okay, well, then, you're stuck. So really, the risk isn't unlimited to a seller in selling a put. The risk is really down to 0, right? So they'd have to buy that stock at 120. And then if they wanted to turn around and sell it in the marketplace and it's worth $1, well, that's a pretty sucky deal, right? So, buyers of calls are bullish. Sellers of puts are bullish. Buyers of puts are bearish, and sellers of calls are bearish. Okay. And again, I'm going to get into a little bit more when we get into an options class, a little bit more examples and details. But in this short little class, I don't want to get too deep into it. Now, I want to talk a little bit, though, about the premium that traders will pay. So options, they trade on the markets just like stocks, right? It's just they're quoted in terms of premium. Now, premium has, there's a formula. And understanding the components of this formula is important as an options trader, okay? Really the formula would be implied volatility plus time value plus intrinsic value. Now, remember in that example, I said that Apple, the seller was willing to basically say, okay, for 30 days, I am going to allow you to lock in a buy price of 120. Okay, but I want $2 a share, or excuse me, yeah, $2 a share, $2 for that options contract, which is $200 because it's in hundreds, right? So that premium, the way he came up with that was based upon a couple things. First off, let's talk about intrinsic value. That's the easiest part of this. Okay, intrinsic value is if there's any true value in the contract right now. So let's say when the seller wrote that contract, okay, that Apple, you're locking in a buy price. So you want the stock to go up. So you're locking in a buy price of 120. But let's say Apple in the marketplace is currently trading at $120.50. So I want you to write this down on a piece of paper. So you're a buyer and you're buying a contract and the premium is $2 a share. But right now, if you think about it, you're locking in a buy price of 120, but Apple's currently trading at 120.5. Is there any value today if you can buy it at 120 and then the current market price is 120.50? Is there value there? The answer is yes. How much value? 50 cents a share, right? Because you can buy it at 120, turn around, sell it in the marketplace at $120.50. So the intrinsic value portion of that $2 premium is 50 cents because that's the true value between the strike price and the current price of the underlying security in the marketplace. Okay, so that's the easiest portion, right? Now, let's talk about time value. Time value is the value to the premium for as much time as you have to hold that to expiration. I mean, if you only have 30 days for that stock to hold to get that locked in price, that value is going to be worth a lot less if you have 3 months. Because think about it, if you've got 3 months to expiration, that portion of that premium, that time value is going to be a lot higher. So what do you think is going to happen to the time value of that premium in the secondary market as the option gets closer to expiration and time starts to evaporate? That portion of the premium is going to go where? Down. Okay, so time value, and in this example, we don't know what the value is going to be priced on that right now, but we know that if you were to look at an option that, let's say there's a couple sellers out there, and this one seller is giving you 30 days for $2 with a 50-cent intrinsic value. Well, you may find another seller that's willing to give you 3 months at a $4.50 premium. Well, why is the premium higher? Because the portion of this option is of the time value is going to be higher because now you have 3 months to hold on to this for the stock to go up versus 1 month. So it's going to be worth more. So when you go out in expiration in time, the premium's should be, all things considered equal, higher. Now, the third portion of this premium is what's called implied volatility. And this is really something that is the most misunderstood portion of options out there. And that is basically the risk component that the maker, the writer, will add to the premium, or that the market will add to the premium, based upon the volatility of not only the stock, but the volatility of the marketplace. Okay. And is there any events that are occurring that could increase, the volatility to this stock? Okay. And now, if we go to measure implied volatility, it's kind of hard, right? But really, you have a gauge that the CBOE has created, Chicago Board of Exchange, which we talked about with exchanges, right, where options are regulated. Well, CBOE has put together what's called the VIX, right? And the VIX is something that all traders, whether you're trading options or not, follow, because when you have an elevated VIX, it pretty much will measure volatility in the marketplace. Okay, so as the VIX is rising, volatility in the marketplace is rising. So when stocks go down and there's a lot of turmoil, VIX typically is rising. So VIX elevated over 20, elevated even over 15 is a higher volatile market. So why do you need to know about this volatility? So if we go back, right, to that formula, the premium, the implied volatility, okay, the market portion of that implied volatility is going to be based upon the VIX. So if you're buying an option when the VIX is elevated, you're buying an elevated premium. Okay. Now, the other portion of that implied volatility is a stock volatility, which is related to any events that the stock may have. So why do you think? Okay, let's talk about an event that may be volatile for a stock. Well, you think an earnings event that's happening after the market closes might be a volatile moment in a stock's pricing? The answer is 1,000% yes. So what do you think happens to Apple premium when the day or the week before, as we get closer to its earnings release time, that portion of the premium, all things considered equal, is going where? Up, and up dramatically. Matter of fact, this is why, okay, a lot of novice investors will buy options, right? Okay, prior to an earnings event, right before the market closes when it's at its peak. And then the earnings, you ever see this? The earnings go through the roof, right? They bought a call and the stock goes up, but guess what? They wake up and their premium is actually lower and they are losing money. They're like, Mike, how can this be? This is impossible. They're cheating me. No, because what's happening, what do you think happens after that earnings event? Now the volatility is gone for that stock, right? Because that earnings event happened, it's known now. And so that portion of the premium is taken away. So that's why you may see a lot of novice investors that will buy an option because they don't want to buy the stock, right? They've been taught, and most people know you're not holding a stock through an earnings event, right? Most people have that ingrained in their system. If you don't, that should be one of your beliefs. Okay, so what happens is they go to options because limited risk from a buyer. I could just put $200 and still get some nice value out of it. Well, what happens is they buy that option, and the implied volatility to buy it when it's at its highest, that gets taken away after the earnings event, and the stock doesn't move enough in intrinsic value to make up for the implied volatility that was added to that premium in the beginning. Okay, so now you're starting to understand, or you're going to start to understand why it's important to understand a relationship of premium and options to the actual value of the options, right? And that's why, really, if we're going back to casinos and you look at the numbers, the option writers are the house. Okay, typically, and I believe, and I don't know the exact percentages, but typically the writers are most options, I believe it's like 90% of the options will expire worthless, which means if the 90% of the options are expiring worthless, who gets to keep the premium? The option writer, the seller does. So as we get into options down the road, you're going to see some really cool stuff, right, on how you can make some money, selling options, especially if you're going to buy a stock, right? So let's go back to I just want to bring up two unique option trades that you can do. Let's say that you're looking at Amazon. Let's say you're looking at Tesla, because Tesla's a little bit more volatile. Okay, let's say you're looking at Tesla, and Tesla currently, write this down, is trading at 425. Write that down. Tesla currently trading at 425. And I apologize about not having an example slide up here for you. But let's say Tesla is, trading at 425 in the marketplace. But you're like, you know what? I'm looking at my charts, and I would love to own Tesla. Okay, and I would love to own Tesla at 300. Well, what you can do is, instead of buying Tesla now or waiting for Tesla to drop, you can sell Tesla puts. Okay, well, let's go back. And now I know you're confused. You can sell the 300 Tesla puts. So let's walk through that. So a put, if we go back to a put, the buyer has a right to sell, which means you as the seller have an obligation to what? Buy. Well, you're looking to buy Tesla anyhow. You're bullish on Tesla, and Tesla's trading at 425. Well, you see a lot of support at 300. Wouldn't you love to have to be able to buy Tesla at 300? Absolutely. So isn't it crazy that some investors are actually willing to buy a contract to pay you to buy Tesla at 300? So you're saying, Mike, who would do that? Because there's stupid traders all over the place. And when you have these, all these people betting and betting money, well, when you have elevated VIX and you have an elevated option pricing, these 300 puts on Tesla, you may be able to get yourself some alpha, some free money. And you could do it just for the month. Sell these puts every month. And guess what? If you realizing that your risk is you would have to buy that stock at that price. So, you can do that and it'd be beautiful. So, and we'll get into that when we do the options class. That's why I don't have a lot of, example slides, because I don't want you to focus too much on options right now. Now, the other point I want to show you is I want you to write this down. You can actually rent your stocks. A lot of people are like, Mike, I love real estate. I don't like to buy stocks because, real estate, I can own my real estate. I can rent it out and get income while I own my property. Stocks, you can't do that. I say, yes, you can. And most people, because they don't have the knowledge, look at me like, like I just, said something that they had, I just, fried their brain. So no, you can't rent stocks. I said, yes, you can. And a lot of people don't realize that you can rent your stocks out, just like real estate people rent their property out. Well, you can do that through what's called a covered call. So follow me here. Just like we talked about the puts on that side, let's reverse it now. Let's talk about selling calls. Well, let me ask you a question. Let's say that you own right now 100 shares of Apple, right? And you own Apple and you've owned it. You bought it at $100 a share, and you're like, Mike, man, what's this deal? I can rent my shares out? Yeah, you can. So Apple currently today is trading at 120. Okay, write that down. Trading at 120. Okay. Well, let's go back to the call contract and go over it again. A buyer of a call contract has a right to buy. The seller has a right to what? Or has an obligation to what? Sell. So, that's fine. Let's say that you write a contract on 100 shares of Apple where you have an obligation to sell at 120. Okay. And Apple is currently trading at, let's say, at 120. And somebody is willing to pay you, okay, $2 a share. Well, let's say, actually, I'm gonna have you erase that. Let's say Apple's trading at 120 in the marketplace. Let's say that you go out and say, you know what? Let's sell a 130 contract. Okay. So you go out and you write a contract to sell Apple at 130, and let's say somebody's willing to pay you $1.50 on that, right? Well, guess what? For the next 30 days, you have an obligation to sell Apple at 130. And somebody paid you $150 for that obligation. Okay? Well, you said, Mike, but you told me in the previous slide, and if we go back here, you told me in the previous slide, and then you go back, that there's unlimited risk. Yeah, but it's unlimited risk if you don't own the stock and you have to go back out and buy it, right? Here, you already own the stock. You own it at 100. So somebody is going to pay you $150, okay, to sell your 100 shares at 130. Are you going to be sad? No. And what did I tell you? That the way options are priced 90% of the time, they expire worthless. So what happens typically 90% of the time at the end of the month? You don't have to sell your stock and you get to keep what? The premium, which is $150. So guess what you get to do the next month? You can rent your stock out again. And there's a good chance that option's going to expire worthless. So you can actually, buy your stock, and as stock goes up, or even if the stock goes down, you can actually, sell these option contracts based upon it. The worst case scenario, the risk is that Apple goes to 200 and you're capped at 130. Okay. But again, we're playing the odds. And the odds are that 90% of the options expire worthless. The odds are, that, as far as what you're playing in your portfolio, you're playing for the consistent alpha return. So we'll get more into that as we go on, but I kind of wanted to explain that to you and give you those two options so you can understand. Now, there's also spreads and vertical spreads and calendar spread, all kind of stuff. We'll get into that. I'm going to do an options class for you in detail, but now you should have a good understanding of options. Now, there are two different types of options, American options and European options. American options you can exercise at any time. European options you can exercise only at expiration. Okay, which is, most of the stocks that we're talking about. And we'll get more into that again. So, recapping options, it's important for you to understand the process. It's important for you to understand options trade just like stock. The key with options that I really didn't get into is the leverage it gives you. If you're a buyer, it gives you a defined risk. I know I talked about the sellers always win, right? But there is some cool stuff if you know how to trade and you're trading short term that you can utilize when you're buying options. You might have heard on the afternoon shows that, when I trade the SPY, I trade SPY options. When a lot of times if I'm trading BABA on some of these international stocks, I'm trading, options. Right? Because it gives me the opportunity, because I'm in and out on a short-term basis, to really trade and capitalize on the leverage situation. Okay. And I don't want to give you that right here, right now, because if I do, you'll be, as a beginner, you're just going to go out and trade options all the time because you're going to look at the leverage. Typical newbies, they look at options, they see the leverage type of situation. You're like, Mike, if I would have bought the SPY, I would have made, only $100. But if I would have bought the options, I would have made $2,000. Well, I'm buying options all the time. Why wouldn't you? Okay. So, when I do the options class, I'll go through that example and that exercise, but there's some risk components that you want to take in consideration. There's some things you want to take in consideration as far as that's concerned. Okay, so I hope that gave you a little bit of a taste of options because I wanted you to get that taste and I thought it was important. So now what we're going to do is we're going to, I know this class has gotten long, but you know what? That means more value for you guys, right? So what we want to do is I want to hand it over to Tyler, who is, again, he's the head of our foreign exchange market. He's head of our FOREX market on the desk. He is the expert at FOREX, and I want Tyler to take it away.
All right, what's up, guys? I hope you're all having a great day so far. So I'm going to try to keep it upbeat, entertaining for you. Take a deep breath, get a glass of water. It's been a while, so I know your brain's probably fried. But if you need to rewatch this section, because what I'm going to try to do is I'm going to try to explain what the Forex market is, and along the way, kind of related to what the Forex versus stocks, And so by the end of this, hopefully you can decide, which market is for you, Forex or stock market. And if by the end you can't decide that still, feel free to reach out to me because I've traded both and I can probably give you, some good input on what is best for your trading style and personality. So starting off, so what is Forex? Well, first of all, Forex is short for the foreign exchange market, or sometimes it's also referred to as FX. So if you hear any of those terms, just know that, they all mean the same thing. So it's actually the largest financial market in the world with a price tag of about $6.6 trillion being traded per day. Now, I compare that to like the elephant and the mouse because if you look at the chart below I gave you, Forex is the elephant. It's $6.6 trillion per day compared to the stock market, which they've just been covering, which is, I think, around $200 billion per day, if I'm not mistaken. It's around there. So it's at, the Forex market is it's overpowering the stock market, which comes with a lot of benefits that I'll go over later. but just know that it is the largest financial market in the world. Now, it's where all the traders, investors, institutions, banks, it's where they exchange and speculate on the world's currencies and where they're valued, and in order to conduct foreign trade and business, so that's where currencies need to be exchanged for business. Which is why you see that price tag of $6.6 trillion a day. So in Forex, when you buy, say, the Japanese yen, you're basically buying a share in the Japanese economy, right? So you're trading currency pairs. It's basically money, the economy's money. So you're betting that the Japanese economy is going to is doing well, and it'll even get better as time goes on, assuming you bought it and you didn't sell it, right? So the current price of the exchange rate, which is you're trading a currency pair, it's US dollar versus the Japanese yen. That's a pair. Now, the current price of the exchange rate is the reflection of many things. Not only is it a reflection of the current and future health of the country's economy, but within that, it includes the current interest rates, the economic performance, sentiment towards ongoing political situations, and as well as the perception of future performance of one currency against another, based on the retail traders, right? So it's kind of a combination of a lot of things what the exchange rate actually represents. Now, within Forex, there are actually there are major currencies, there are minor currencies, there are exotic currencies, but as a beginner, and actually what most people focus on are the major currencies. And the major currencies are USD, which is the US dollar, the Canadian dollar, CAD, GBP, which is the Great Britain pounds, EUR, which is the euro, CHF, that's the Swiss franc, AUD, Australian dollar, JPY is the Japanese yen, and New Zealand, which is the NZD. So with those major currencies, sometimes there are nicknames for those that you might run into, and you might need to know what they are. For the US dollar, sometimes people refer to that as the greenback. For the euro, the Eurozone euro, that will be referred to as fiber. Japanese yen is referred to as yen. The Great Britain pounds is referred to as cable. The Swiss franc is referred to as Swissy. The Canadian dollar is loonie. The Australian dollar is Aussie. And the New Zealand dollar is Kiwi. So if you hear any of those terms, just know that's what they're talking about. So some important factors just within the Forex market. And this is where I want to kind of give you an overview of when you're trading the market, what's involved, what you're looking at. So first thing to note is the market hours. Now, there are 4 major trading sessions. It's Sydney, Tokyo, London, and New York. So, the Forex is a 24-hour market, 5 days a week. It never closes, and I'm going to tell you why. It'll open up Sunday around 5, at 5 p.m. Eastern time, and it doesn't close until Friday at 5 p.m. Eastern time. It's always running. And the reason for that is because trading just shifts to different financial centers around the world because there's different time zones. So it will start with Sydney, it's 5 p.m. Eastern time to 2 a.m. Eastern time. Tokyo, 8 p.m. Eastern time to 5 a.m. Eastern time. London, 3 a.m. Eastern time to 11 a.m. Eastern time. And New York, which is 8 a.m. Eastern to 5 p.m. Eastern. Now, within those time zones and those sessions, there are overlapping times and overlapping market hours. So if you wrote down the times I mentioned, Sydney and Tokyo overlap at one point. Sydney opens at 5 p.m., Tokyo opens at 8 p.m. So at 8 p.m. until 2 a.m. is when they overlap. So when you're trading any session, you're going to want to note when the overlapping times are, because that's when the volume, that's where the big rush of volume is when they overlap. And You also want to note, depending on what pair you trade, if the banks are open at that time. So if you're trading, for example, the Great Britain pound versus the U.S. dollar, and you're trading at 3 a.m. when London opens, well, just note that at 3 a.m. London's open, so you're going to see some pound movement. But note that the U.S. banks are not open. So with the market action over London session, you're going to see a lot more influence with the pounds and what what London's doing versus the dollar. So just note that, right? So moving on into the Forex spread. Now, there are actually two different types of spreads, right? Because there's a ton of different brokers out there. And depending on what broker you have, they have different different types of accounts. Now, you'll have one account where you'll have a very, very tight spread, but you'll also get charged a commission on top of that. So you might have, a 2 pip spread, which I'll go over what pip is in a second. But then you'll have also like maybe a $4 commission on top of that, or depending on what size you get in the trade. So you'll have a small spread with commission, or sometimes brokers will combine their commissions into the spread. So your spread will be a little larger, but you'll have 0 commissions on top of that. And now what I'm talking about, the spread is the bid-ask spread. We've talked about that before, but it's what you're buying it at and what the market makers are selling it at. So that spread is where the commissions are involved. So that's one thing to note with Forex and trading it. Another thing I want to talk about is leverage, right? And leverage is the biggest thing that Forex has to offer. Now, there are common leverage ratios. The United States only allows up to 50 to 1. So if you put in $1,000, they'll let you trade 50 times that. But if you open up an account, a foreign account, then you'll see common leverage ratios 100 to 1, 200 to 1, and up 500 to 1. Sometimes you'll see 1,000 to 1, but it's not as common. Now, what Forex has to offer is there's no minimum capital contribution. There's no $25,000 pattern day trader rule and like the stock market has. So if you only have $1,000, $50 to trade, you can start trading Forex and just get a 500 to 1 leverage account, and you can start trading right away. You don't need a lot of money to trade Forex, which is one of the great things about Forex and the leverage it provides. Obviously, given that it's a huge leverage, it also gives a huge risk. If you're trading with a 500 leverage, then your risk could be multiplied by a huge amount. So you got to take that into consideration when you're trading Forex and you're getting a 500 to 1 leverage. Yes, you can trade with a small amount of money, and you can make a lot of money at once, but you can also lose a lot of money at once, even blow your account, which is why a lot of people blow their accounts, because they over leverage, which is a big problem in trading, right? So what I want to also mention is lot sizes. Now, a lot size, it is it's the amount of shares that you buy. So if you buy 100 shares of a company, well, instead of being shares, it's called lots in Forex. So there's different types of lot sizes. There's standard lot, which equals to 100,000 units of a currency. There's a mini lot, a micro lot, and a nano lot. A mini lot is 10,000 units, a micro lot is 1,000 units, and a nano lot is 100 units. Now, that's another good thing with Forex is you can buy, fraction shares. You don't have to buy a full amount. So if you don't have a lot of capital, you can get that 500-1 ratio, the leverage, and then trade micro lots. Now, micro lots, since it's about 1,000 units for a currency, and the standard lot is 100,000 units, well, you're buying 0.01 instead of 1. So, just keep that in mind when you're trading a small account. You want to trade the smaller micro lots. And now nano lot sizes aren't common, which is why I hesitated even mentioning them. I've only ever seen it once, and it's with the broker Oanda, OANDA, but that's a US broker. So even with that, you can only do a 50-to-1 leverage. So, nano lot sizes really are non-existent. So then now, moving on to stocks versus Forex, I want to give you a quick breakdown of how they compare. And this is going to be the main slide for you guys in deciding, which market is best for you. So starting with the similarities, the charting. Now, charting, it's obviously the same. You have support and resistance, trend lines. Now, when you see a currency chart, it's going to look exactly the same as a stock chart. It's going to have your candlesticks, it's going to have your trends, your consolidation. So they'll look exactly the same. You chart the same. The support and resistance is the same. So pretty much technical analysis is the same on stocks versus Forex. Now, with that, I want to note that Forex is majorly technical analysis based. Like, you really won't have to know a lot of fundamentals within Forex. There's only a few you should really know, which I'll cover in a little bit. But if you're looking to just mainly do technicals, Forex is the way to go, because it's strictly like 90% technicals until you get a couple different red folder events. So then another thing is executions and order types. Now, they're going to be the same. You're going to buy, you're going to sell. So you're going to execute the same way. You have the same order types. You have a market order, you have a limit order, a stop order. So executing in stocks versus in Forex is the same as well. Okay, so you're not going to see difference in there. Another thing, which I guess you could say it's similar and different, because there are some tools in Forex that aren't offered in the stock market, but just note that for the most part, tools are going to be the same. As far as different tools you could draw on your chart, different tools you could use as far as like journaling or journaling or using a calculator, tracking trades, any of that stuff. For the most part, it'll be similar. So that's going to be the same as well. And then lastly, similarities as far as the stock and Forex market goes are indicators. I haven't yet seen any different indicators because, like I said, the chartings are the same. So you have the RSI, the moving averages, Bollinger Bands, all the different indicators that you could use on stocks, you can use it in Forex as well. So as far as charting goes, with all the indicators and tools and execution, that's all the same. Now, what the difference is more the fundamentals of Forex and how you actually, and what's going on behind the scenes. So, like I mentioned before, the market hours. Now, the market hours are different because in Forex, it's 24 hours, like I mentioned, Sunday to Friday, 5 p.m. It opens a Sunday, 5 p.m. it closes Friday. Now, with the stock market, it obviously opens at 9:30 a.m. to 4 p.m. But then you have the pre-market at 4 a.m. and then the afternoon market at 4 p.m. to 8 p.m. So the market hours do differ. So if you have a very tight schedule and you need more flexibility in when you can trade, well, I recommend the Forex market because it's 24 hours and you can really adapt your schedule to trading at that point. Another thing to note is the volume. Now, I showed you that chart before. Forex is considerably larger than the stock market. You'll have zero liquidity problems, zero execution issues. Now, there's never issues with volume or execution because you'll get instant orders at the desired price you want, no matter there's no problem with that. Liquidity in the Forex market is huge. Now, it is important to note that there's no investor-to-investor trading in Forex. You're really just trading with the market maker. So you're going to get filled no matter what. You won't have those issues getting filled. Like sometimes in the stock market and in different cases, you will have execution issues and you'll have some slippage in stocks, if it's a very thin stock or, because there must be an investor on the other end of your order in the stock market in order to get filled. So sometimes in certain situations, you can have execution orders in the stock market, which is why the volume in the Forex market is a very important thing to note. So as far as short selling goes, in stocks, sometimes you'll get the, SSR, the short sell restrictions, or the uptick rule. So sometimes, hard to borrow, might be hard to short a stock. Well, in Forex, it's the same exact thing as buying. You're not going to have any issues. You'll get filled right away. It's just because you're trading with the market maker, and it's such a liquid market, and you're trading the economy of a country, that you just won't have any problems with the short selling. Market. So another thing that's different, and this is something that's a big con in Forex, is the market manipulation. Now, market manipulation will mostly depend on which broker you're going with, because they have more or less two different types of brokers. There are three because there's a hybrid, but I'm going to list the two. There's an A book and a B book. Now, the A book, there's really no conflict of interest because you're getting filled directly to the liquidity provider. You're not going from the broker then to the market maker. And the B book, now you're running into some issues because the brokers will trade against you, and assuming you're going to lose, because they keep your trades in-house. They don't send your order to the market makers. It's getting filled in-house, and which is why the problem with Forex is it's unregulated, so they're able to manipulate price, which is what I've seen a lot the past week or two. Because if you're trading with a B book broker, then they'll see your stop, they'll spike it up or spike it down to your stop, and then end up going exactly where you thought it would, because they're trading against you. They want to win, they don't want you to win. So that's why I recommend A book brokers. So that's, market manipulation is something to watch out for. Another thing is narrow versus wide focus, right? So in a stock market, sometimes you'll buy to hold, you'll want to gain dividends, or you're in it for the long run because the company looks attractive. Sometimes you can actually buy and hold it, right? But in trading Forex, you won't find any trader buy and hold because, oh, the economy looks good. Like, you might see somebody buy and hold for a few days, a couple weeks, maybe a couple weeks. But the problem is you're trading currencies in the economy, and something could come out so quickly and just disrupt what you're looking at that, it's a lot easier to day trade the Forex market, because you're looking at current price action in the economic situation, which can change overnight. So you don't look at that wide focus, the wide view of, okay, the stock's doing well, it has a lot of upside potential, it has a great CEO. You're looking at that, all those great factors, it has good dividends, but you don't look at any of that in Forex market. You're day trading, you're trading to make money, you're speculating. You don't have any ties to any companies or any economies. You're just trading off of technical analysis and trying to make money off of the price movements. Obviously, another thing is the leverage. Now, in stocks, you only get that 4-to-1 leverage if you decide to use it. But in Forex, like I mentioned, you get up to about a 500-to-1 leverage, and you only need around $50. And I think actually, I said there's no minimum contribution to trade. Most brokers actually, require $50. Some are actually $10. So obviously there is a minimum, but you're not going to trade anyway if you don't have $50 to put in. So that leverage is obviously a big difference as well. So moving into if you're going to start looking at Forex, what tools I use and the tools that I highly recommend, which it'll change your trading career. First off, TradingView. All right, TradingView is the charting platform I use, and I do not recommend anything else. It is the best charting platform I've used. Now, if you're trading stocks, they've mentioned that they use Thinkorswim with TD Ameritrade. I mean, you can use TradingView with stocks as well, but I mainly recommend it for Forex because there's nothing else other than trading or charting on your MetaTrader 4 platform, which is what you use to trade off of. their charts suck. TradingView, if you're trading Forex, is what you're going to want to use to chart. Okay. My FX book. This is probably the best thing any trader could have in the Forex market, right? So this website, it's myfxbook.com. They have everything. They have your live news. They have an economic calendar. They have any calculators you might need. They have this thing called a community outlook, and it tells you what percent of traders are net long or net short currency pairs. So you can kind of use that to say, all right, well, 80% of traders are short GBP USD. You might want to look for a reversal there, and you might want to look for a little bit of a short squeeze. So they have that, and then one big thing that I use my FX book for is a portfolio. Now you can connect your trading accounts to a portfolio, and it will track every trade you make. It'll track your longs won, shorts won, best trade, worst trade, the average win, average loss, the profitability, the amount of trades you take, the profit factor. It's just it has so many different things it tracks as far as how you're doing, that you almost don't even need a journal, which obviously you need a journal, but it's that good that you can just analyze my FX book portfolio and see what's going wrong. Another tool that I use that I highly recommend you use, which is what helps me turn a corner into being profitable, is Trixie. Now Trixie is a trading journal. In Forex, it's the best trading journal that you can use. You literally you type in your analysis, where you got long, why you got or short, why you took that trade, where your stop was, what your entire process was in the trade, and why you took that trade, why you lost, why you won, things you could have done different. It is the best trading journal software that I have ever come across. Other than TraderView, I think it's called, which is what we use for stocks, and they, that's obviously the best one for stocks. But if you're trading Forex, Trixie is the way to go. Another thing that I highly recommend that will honestly, it will change your risk management and your money management, your trade management. It'll change it so much for the good. It's called Magic Keys. Now, I don't have any affiliation with them, so whether you use it or not, I don't care, but I highly recommend it because it's what I use, and ever since I got Magic Keys, my trading has just compounded and excelled so much. Now it's only for Forex. You can't use it for stocks. And there's nothing like it out there, but it is the best trade management tool you could use. You don't have to calculate, all right, what size am I getting in? How much am I risking? Where's my stop? Where's my take profit? Can I scale out? It does everything for you, with a click of a button instead of you trying to calculate stuff. The best tool, hands down. If you take anything from this tool list, Magic Keys is the best. And then lastly, I'll end off with Forex Factory. It's not really a tool, but it's a website, forexfactory.com, that gives you what all traders use, a economic calendar and breaking news, a live breaking news feed, which, if you start seeing one of your pairs take off out of nowhere, you look at Forex Factory under the breaking news tab, it'll tell you, what came out, and you can kind of trade accordingly. You can see what bank holidays are out, what pairs, have what economic news today. Forex Factory is what I use and what pretty much any other Forex trader uses to track news and economic holidays and stuff like that. So, if you have any questions about what I went over, or want, any more in-depth analysis, or want help figuring out, if Forex is good for you or not, please don't hesitate to reach out. I'd love to help out because I've been in your situation. I've been, should I trade stocks? Should I trade Forex? And I know what it takes, what personality and what your lifestyle is like. I can probably help a lot. So with that being said, I want to hand it back over to Mike so we can close this out. And thanks for tuning in with me.
Thanks, Ty. I really appreciate that. And, I know this video went a little bit longer today, but, believe it or not, we got a lot to really get out to you guys. And I want you to have as much exposure as possible. So the big thing is right now, guys, this is the end of week one. You should be working on your the two portions of your trading plan that you need to work on. You need to make sure you get those done. We are going to have a mentorship group on Zoom this Sunday at 10 o'clock Eastern time. So again, drop us an email at info at vanttrading.com, and then you can get us, we'll get you a part of that group. So I hope this has been informative for you, and safe trading going forward. And next week we're getting ready to take it up a notch and get you going and start adding more to that to your trading plan, and get you really moving forward. Safe trading, guys.
Well, have a good weekend, guys. All right, we're good.